Hi, my name is Ameya Abhyankar. I'm the founder and lead trainer at FinQuest Institute. In this video, we'll introduce ourselves to derivatives. This is one of the topics of the FRM Part I examination. The learning outcomes for this topic are enlisted on this slide. So in this video, we'll discuss a few points which are enlisted here. So understanding the meaning of a derivative first. So a derivative is defined as any product which derives its value from an underlying asset. So the movements in the underlying product are going to cause the price of the derivative to move. So which all products can act as underlyings? So you could have a host of products. It can be equities, foreign exchange, interest rates, commodities, bond prices, etc. Derivatives are further subclassified into linear and non-linear derivatives. So by linear derivatives, we mean these are derivatives whose payoff is linearly dependent on the movement of the underlying. Popular examples of linear products include forwards, futures. Let's take a simple example. Assume parties A and B have entered into a forward contract. And let's say party A is making X dollars on this contract, positive X dollars. So that will mean party B is losing an equivalent sum. So party B's position will be minus X dollars. So if we sum these two together, we reach a value of 0. So linear products are also what we call as those that generate a zero-sum game. Coming on to non-linear products. So popular examples of non-linear products are options. So what are options we'll study in a minute. But assume that I am an option buyer. Then I pay a certain premium upfront to the option seller. And assuming it's a European option, I wait till option maturity to see whether I'm making money on the option. So the payoff on the option is not linearly dependent on the movements in the underlying. That's why options are classified as non-linear products. Now derivatives trade on two avenues. One is exchange traded derivatives and other is over the counter derivatives. So let's try to understand what are exchange traded derivatives and a few properties which are peculiar to exchange traded ones. So first is standardization of products. So any derivative which trades on the exchange follows a certain standardized structure. By that we mean the terms of the contract, the different conditions, etc. are completely standardized and they are defined by the exchange. Now, exchange traded products show high liquidity. That's because whenever we have any derivative which is listed on the exchange, we have more number of market participants that are willing to take positions in those derivatives because these are standardized products and market participants find these products appealing for their requirements. So as the number of participants increase, the liquidity which is offered by an exchange traded derivative is high. Then exchange traded ones are also heavily regulated. So every capital market comes under the purview of a capital markets regulator prevalent in that particular jurisdiction. So these exchange traded derivatives will be regulated by the capital markets regulator. And the main idea behind having a complete regulation is to ensure that the market decorum is maintained and investor interests are protected. Then presence of a CCP or a central clearinghouse. So every exchange provides what we call as a CCP. So CCP provides clearing and settlements of transactions. So the idea behind having a CCP is to reduce the credit risk which is embedded in a derivative transaction. So you can imagine a CCP to be like an independent unit which is functioning within the exchange. And the sole function of a CCP is to ensure that whatever derivative trades are happening on the exchange are cleared and settled. That is, they prevent any defaults from happening. So that's why we say credit risk is mitigated whenever a CCP is present. The price discovery for exchange traded derivatives is better. That's because we have more number of market participants that are transacting on exchange traded derivatives. So more the number of buyers and sellers, the better would be the price discovery for any product. Now coming to OTC derivatives. So the first property of OTC products is customization. So you can customize OTC products to your requirements. Now this is in contrast to what we have discussed for the exchange traded derivatives. Now OTC contracts are specifically designed so that they are tailor-made to the requirements of the counterparties. So whenever a counterparty has a specific requirement, they can approach the OTC market. So for instance, let's say there is one counterparty who wishes to purchase crude oil, and if they wish to purchase say 1100 barrels of crude oil at a certain point in time. Now assume that exchange has futures on crude oil. However, these crude oil futures are only for 1000 barrels. Now the requirement of the counterparty is 1100 barrels. So there's still a difference of 100 barrels and the counterparty wishes to completely hedge their position. So in this condition, rather than going to the exchange, the counterparty will approach the OTC market and they'll transact with another counterparty to take a complete hedge for their 1100 gallons of oil which they want to hedge. So this is what we call as customization. The liquidity is lower because in a OTC market, let's say I am one of the counterparties, so I am entering into a customized transaction with some other counterparty. So the requirements which I have are being met by that particular transaction. So these are unique requirements to me. So it may so happen that there are very few market participants who have requirements similar to mine. So that leads to lower number of market participants interested in taking a trading position with me. So that drives down the liquidity in the OTC segment. Then the amount of regulation which is there for a OTC derivative is lower as compared to the exchange traded ones. Then there may or may not be a central clearinghouse for a OTC trade. However, post 2008, the growing trend in the market is to have more and more of OTC transactions on a central clearinghouse. So large CCPs globally like LCH ClearNet or Euroclear, these are two prominent ones which provide CCP services globally. The price discovery for OTC products is difficult. So depending upon the degree of customization that has gone into a product, price discovery can become a challenge. Now OTC derivatives will allow exotic products to be designed. So the beauty of the OTC market is, since it allows customization, as long as you have a willing counterparty to take the opposite side of the trade with you, you can design any contract you like. So that gives a lot of flexibility to market participants. So a lot of structured and exotic varieties trade in the OTC segment. A forward contract is a contract between two counterparties to either buy or sell a certain product at a certain price at a specific date in the future. So imagine that I want to purchase a certain asset from a counterparty, and I'm concerned that that particular product is very valuable and the price is volatile. So imagine that I wish to purchase the product in 1 month's time and my target price is $100. So I want to pay nothing more than $100 for this product. So this is the product price which I have frozen and I want to transact only at this price. So I approach the counterparty and I tell the counterparty that I want to purchase this product in 1 month's time. So my time to maturity is 1 month. However, I want to freeze the price to $100. So let's enter into a forward contract today, so that in 1 month's time, no matter where the price of that asset is, I will be purchasing the product at $100 from you. So if your counterparty is willing to enter into that transaction, then you have a forward trade. So let's say we are at small t is equal to 0, which is today. So I enter into the forward contract today. So for entering into the forward contract, I need not pay anything. There's no upfront payment required. Now I don't do anything for the next 1 month. Now at the 1 month point, whereby I have to purchase the asset, I go to the counterparty, I pay $100 to the counterparty and I purchase the asset. Now, there can be two scenarios which we would like to analyze at capital T is equal to 1 month, which is my maturity. Now the price can be higher or lower than 100. Now, if the price is higher than 100, so imagine that the price at maturity is $150, then I'll be immensely happy because I am getting to purchase an asset at $100 when the actual transacting price is $150. So I am saving $50 on my trade. Now contrast this with a scenario where the price of the asset has dropped. So let's say the price at maturity is just $50. Now here I would feel that I would have been better off not entering into the forward contract, because in this case what is going to happen is I have to still pay $100 even though the market price for that asset has dropped to 50. So I'm losing $50. Now the thing with forward contracts is this is like a commitment. So you can also imagine forward contracts to be like a forward commitment. So at t equal to 0, I am making a commitment, or me and my counterparty are making a commitment to each other that we will definitely honor the terms and conditions of this forward contract, and at 1 month point we will transact. So there's no way out on this trade. So that commitment has to be fulfilled. So even if the price is unfavorable to me, I still have, either to me or the counterparty, neither of us have the option to exit the contract. We'll have to honor the contract, and that's how a forward contract functions. Now for any contract, you have a buyer and seller. So in derivatives, we call these as the long and short positions. So you can imagine long to be synonymous to a buy and a short to be synonymous to a sell. So the holder of the long forward contract has an agreement to buy the asset. So in our example, I am holding a long position in the forward contract, and I had committed to purchase the asset at $100 in 1 month's time. So that is precisely what this definition says right here. So there are 3 points which will summarize any forward contract. So the buyer or seller for a forward contract will acquire a legal obligation to buy or sell a particular underlying asset. The expiration date is fixed and the delivery price is fixed at initiation. So going back to our example, the legal obligation was to purchase a certain asset from the counterparty. Then the expiration date was fixed, which was 1 month, and the delivery price was fixed at $100. So this is how we can correlate these 3 points with our example. Now going to futures contracts. So futures contracts are like a natural progression to a forwards contract. So a futures contract is very, very similar to a forward. So in this also you have a long and a short position. So if you're a long position, then you're making a commitment to purchase an asset at a certain price at a certain point in time in the future. However, there are a few subtle differences between a future and a forward. So what those differences are, we'll try and understand. So first and foremost, futures contracts are traded on an exchange. Unlike forwards, which are traded on an OTC. So whenever you have anything which transacts on an exchange, the terms and conditions for that contract are standardized. So the exchange in the respective jurisdiction is going to decide what are the standard terms and conditions for a futures contract which trades on that exchange. Then the definition for long and short side will remain exactly the same as a forward contract. Liquidity for futures is generally higher as compared to forwards, because since they are listed on an exchange, you have more number of counterparties that are transacting futures. Then exchange acts as a central clearinghouse. So this is the CCP feature which we had briefly discussed. And as we said earlier, futures contract have a predefined maturity, futures price, and here you also have a method of delivery which is fixed. So you can either have a cash settlement or a physical delivery. So generally, financial products are settled on a cash basis, whereas many of the commodity products are settled on a physical settlement. So when I say a physical settlement or physical delivery of the underlying, imagine that I have entered into a futures contract to purchase, say, 100 barrels of crude oil. So that will mean at contract maturity, my counterparty is going to deliver physical 100 barrels of crude oil to me and I have to make a payment accordingly. So that is what we call as physical delivery. So option products give the right but not the obligation to buy or sell a certain specific underlying security at a specific price at a predefined time in the future. So that's why the name options. Now there are two counterparties to an options trade as well. So you have a buyer and a seller. So a buyer is also called as the option holder and the counterparty is called as the option seller or the option writer. So the option buyer has the right, but there is no obligation on his or her part to exercise the option. So for that feature, the option buyer has to pay a certain amount of money to the option seller, and that is what we call as an option premium. So the option writer or seller receives a premium amount from the buyer, and this is an upfront premium which the buyer makes to the option seller. Now, options are divided into European and American options. Now, when we say European options, these can be exercised only at maturity. And an American option can be exercised at any time up till maturity. So imagine that there is an option contract and let's assume the tenor for that contract is 1 month. So if it's a European option, that will mean that if I am the option buyer, I purchase the option today and I hold on to that option for the entire 1 month. So I cannot exercise the option prior to 1 month. Now, if I contrast this with the American option, now assume this is a similar American option, then imagine that I've purchased the American option, so I have the right to exercise that option at any point in time from the date of purchase right until option maturity. So here we see that American options give a lot of flexibility as compared to European options. So the price of American options is also higher as compared to the European ones in order to account for this flexibility which American options provide. Further, options are divided into call options and put options. So let's assume I'm an option buyer. So a call option is a right to buy, whereas a put option is a right to sell. So more about call and put options in our next slide. Now options market is very huge. So they are traded both on OTC as well as the exchanges. Now understanding the call option. So every option has a associated option payoff. So what a option payoff is can be seen through this equation. So C of T is called as the option payoff for a call option. And on the right hand side, we have the payoff condition, which is max of ST minus X or 0. So ST is my underlying price at maturity, which is capital T, minus the strike price of the option. So strike price is something which is a predetermined price whenever we are entering into the option contract on day 0. So this price is frozen. So depending on the movements in the underlying and where the underlying ends at, so finally if it's a European option, where the underlying is ending at maturity is going to determine whether this option is giving you a positive payoff or a 0. So So that's why you have a max of ST minus X or 0. Now this is from an option buyer's perspective. Now from an option seller's perspective, this is minus of max ST minus X or 0. Now to see what is the profit from a call option position, so we'll understand it from both the option buyer and the option seller perspective. So let C0 be the call premium. That is, this is the upfront premium that has been paid by the option buyer to the option seller. So the profit for the option buyer is nothing but the difference between CT, that is the option payoff at maturity, minus the premium which has been paid. Whereas for option seller, the profit is going to be the premium which has been received at initiation minus the option payoff at maturity. So the payoff equation which we have studied, this can also be shown in a diagrammatic form. So this is what we call as a payoff chart or a payoff diagram. So how a payoff diagram looks for a call option, we'll understand. Now this is a payoff diagram for a call option. So we'll try and understand both how a buy and a sell call look like on this chart. Let's assume this to be point 0. So you see that whenever we are talking of a buy call option, we start from a point which is below 0, and this distance is represented by C0. So C0 is nothing but the upfront premium which a buyer has to pay to the seller. So that's why we show it below 0, because this is a payment or a cash outflow from the option buyer to the option seller. Now X is my strike price. So if it's a buy call position, then this will start generating a positive payoff for the option holder only when the underlying starts exceeding the strike price which is given by X. Now contrast this with the option seller. So in case I have sold the option to a counterparty, so that means I am receiving a premium. So that's why you have a plus C0 here, because this is a cash inflow for me. I have sold the option to a counterparty. So if I have sold the call option, then I will be in the money as long as the underlying price is below the strike price. But after the underlying starts exceeding the strike price, I start losing money as an option seller. Now the break-even price is given by X plus the premium, which is shown by the point right here, which I'm encircling in red. So to understand the profit for the buyer and seller, so for an option buyer, the profit is given by the difference between ST minus X and C0, which is a call premium which was paid upfront. Whereas for an option seller, the profit is going to be X minus ST, that is the strike price minus the underlying price at maturity, plus the premium which was received from the option buyer at contract initiation. Now let's understand the payoff for a put option. That's given by the first line right here. So PT is the payoff on the put option at maturity, and that's given by max of strike price minus the underlying price at maturity, and it's floored at 0. So this is again from an option buyer's perspective. And from a seller's perspective, it is minus of max X minus ST and flooring it at 0. To see the profit for a put option, so similar to a call option, we'll try and understand the profit from the buyer and the seller's perspective. So let's say P0 is the put premium which was exchanged at contract initiation. So from an option buyer's perspective, the profit is the put payoff at maturity minus the put premium which was paid at initiation, that is PT minus P0. Whereas for option seller, the profit is the put premium which was received at initiation minus the put payoff at maturity. Now let's try to understand a payoff diagram for a put option, something similar to what we had discussed for a call option some time back. So the payoff for a put option, We'll understand it both from a buy and a sell put position. So understanding the buy put position first. So similar to a call option, whenever I am buying a put option, I have to pay a certain premium. So that premium is represented by P0 or minus P0 to be precise. So this is a cash outflow from an option buyer to the option seller. And the put will start generating a positive payoff whenever the underlying price falls below the strike price X. Now from an option seller's perspective, so the option seller receives an option premium at initiation. So that is what we show as plus P0. And the option seller will start losing money whenever the underlying price falls below the strike price X. So the break-even price is given by X minus the premium involved. Now let's try to understand the profitability position from the buyer and the seller's perspective. So for an option buyer, the profit is given by the difference between the strike price and the underlying price at maturity and the option premium which was paid upfront. Whereas from an option seller's perspective, the profit is the difference between the underlying price at maturity minus the strike price plus the option premium which was received at initiation. More about derivatives and other important concepts for the FRM examination will be discussed in our core training sessions for FRM which we conduct at FinQuest Institute.